been a good run. But you know what's gonna, I will never actually wish for this because that would be a horrible thing. But it would take a pretty significant market correction for some of that money to shift, because you're talking, you know, maybe 90 bips of portfolio savings. But what's the tax hit, and what's the holding period? So people are doing that math, and we have a lot of conversations with clients that are sort of biding their time. Because they see how they could use some of these beta products in an active construct, or you know, an active strategy that they're deploying, but they've got to be sensitive to, you know, in the retail space, to the tax ramifications.
Absolutely.
But we know that one of the great catalysts for the adoption and acceleration of ETFs was the global financial crisis, right? That's when investors recognized that what they were paying for in many expensive products was not being delivered, be it outperformance or downside protection, and so switching to a lower cost product where you knew what you're going to get from a performance standpoint, good or bad, led investors to consider ETFs. And so we know the market's going to trend down at some point, and it could be the next wave, could catalyze the next wave of ETF adoption.
All right, so market turmoil could be the catalyst.
Yeah, I also think that we're moving from a time when we used to talk about active and passive, when the reality is now, when you see the growth, for instance, of factors and thematics, you have many instances where ETFs are instruments of active returns. So I think investors, the more that they understand that, the more that they're not thinking just about index in terms of cap weighted, but they're moving into factors, they're moving into thematics, they're looking for alpha in the index world.
Yeah, and so just to continue on that theme, and you mentioned sort of the crisis. That's been such a big part too of the growth of ETFs, not just that point in time, but you think about how many firms took a step back and said, you know, just from a how do we want to run our book of business? Do we want, you know, if you think about the wealth management business, do we want wealth managers or brokers out there sort of doing their own investing or, you know, acting as PMs? Or do we want to try and push models down from on high that just says, look, the asset allocation is really critical. We've got a bunch of very smart people sitting here that can create those asset allocation models. Use these for your clients and go out there and then make sure you're servicing and taking care of the estate planning and the tax issues and the stuff that, you know, adds another layer of return for the client. And the ETFs were a really, really good vehicle to execute upon those you know, very active allocation plans with a diversified low cost vehicle. And that you know, was part of that hockey stick growth.
So using these passive products in an active way, using an active mindset to apply these products. Let's talk a little bit about the zero-fee trading platforms, because in any discussion of cost, this has to come up. The list of places where you can trade stocks or ETFs for free is getting longer. Wells Fargo, Wells Trade this week, Bank of America's Merrill Edge, Charles Schwab, TD Ameritrade, E-Trade, Interactive Brokers. For you guys at BlackRock, Armando, isn't this bad news when you had an exclusive deal with Fidelity to sell your ETFs for free, but that edge is basically gone now?
Yeah, look, I mean, I think that this is positive for ETFs. This will expand the use of ETFs. The more that we can remove the friction that a client has in utilizing ETFs to build portfolios, to gain exposures, this is positive for the industry. So I don't see this as a negative to us or to the industry. This is a real positive. We'll help. The biggest beneficiary are the clients, and clients will continue to use ETFs to build portfolios. So I see this as a positive.
I think it accelerates greater ETF usage from a variety of client types. Financial advisors, on average, 20% of advisor assets are in ETFs today, according to the Sterling research, thereabouts. And so you look at ETFs relative to a mutual fund, increasingly the ETF is going to look like a better option because that friction around commissions doesn't exist for ETFs, may exist for certain funds they want to consider. And then even the individual investor. The individual investor who doesn't have an advisor, it uses ETFs in a relatively small way today. Again, they now can consider an ETF at zero commissions, at a low expense ratio, whereas a high commission might be placed on their mutual fund they want to buy on one of those platforms. So I think this is only more fuel to the fire in terms of more ETF adoption.
All right, let's talk about how some indie issuers complain that the ETFs that they launch, the cutting edge ones that they launch, some good ideas, the thematic ones, they do a great job of it, but they don't have the distribution, they don't have the awareness that you guys do. And as a result, it's something that you guys look at and you copy it and you put it out there with a lower cost and it does a lot better. Are you ripping them off?
Don't look at me.
I'm looking at you.
I think you did it to us. Not worried about the little. Anyway, I did it to me. I'm not sure. I've worked at all three at this point. So I don't know if I completely agree with that. I mean, look. All of us, anyone who in this business is constantly looking at what the competition is doing, and you might see something that there are a couple funds that have taken in some decent flows over the last year or so that have been down a different road, and that's great. But if it doesn't fit your client or the way that you distribute or your brand, it doesn't. You're not necessarily just going to say, oh, let's just go in there and I'll just drop this product in and try and grab some assets, because it probably doesn't fit with your range or your way of interacting with clients. The flip side of it is that we'll have clients come to us and say, like, hey, there's this thing, it's interesting. I think about it slightly differently, right? Is there a variation of the theme that you'd be willing to launch? We like this weighting better than that. We'd like this part of the market included and not. So I think you see variations, and that certainly happens.